Great to be here today with Phil Joseph from Hamilton Lane. Hamilton Lane are a global private markets investment management firm with over 30 years of history. I want to read the stats here so I don't stuff this up. They manage over 850 billion with 41 billion of capital deployed in 2022 alone. 23 offices globally and over 600 staff. So fair to say that you guys are an absolute behemoth in the space that you operate in. Great to have you in the office with us. Look, I suppose let's just take it back to what private markets are. A lot of our investors and people that we deal with are familiar with listed equity markets, but if you could maybe just explain to those who may not have an understanding of private markets and probably more specifically private equity, some of the characteristics and how they might differ to listed equities.
I'd love to, and thank you very much for having me in, Bart. So I think at that most simplest level of explaining it, private markets are simply investing into businesses that are not listed on a public stock exchange. And the sort of opportunities that present itself in that universe is almost 9-to-1 relative to the public market. So it's a big piece of the pie in terms of our economy as a whole. I actually started off my career in the public markets. I was working for one of the largest sort of listed real estate teams in the world. And when I joined Hamilton Lane about 4 years ago, that was my first sort of foray into the private markets. And I think the biggest learnings for me transitioning across was that it's actually quite an inefficient market, the private markets. There is no such thing as a Bloomberg terminal where you can sort of log on and you get the exact same amount of information that everyone else in the world has. And there's no such thing as a sort of a CommSec trading app or whatnot where you can just go in and access every other deal that exists in the world. In the private markets, access to information and deals is not equal. It really does come down to who you know and what you know, and that often can be a huge edge in sort of finding alpha over some of your peers.
I suppose one key point of difference between private markets or private investments and listed equities are how they're priced. We obviously know that listed equities, it's a live market. Can you, I suppose, just describe how your assets are priced? What's the process behind that, and what does that mean for the volatility of the underlying assets or the fund in which they're managed?
It's a very good question. I think particularly topical at the moment, given that last year there was such a sort of distinction between what was going on in the public markets, which traded down quite aggressively, and then the private markets were fairly flat to somewhat up. And so there was a lot of questions being raised around how the valuations work. Traditionally, the way that private market valuations are done are by the actual private equity firms themselves, and they'll release the updated valuations of the businesses that they're managing on a quarterly basis. With our fund, it's priced monthly, so quarterly valuations, that's not going to work. So what we do is we actually employ a third party called S&P Global. They're the largest valuation business in the world, and they'll come in each month and they'll look at every underlying direct position in our fund, and they'll look at 3 different sort of metrics to help them come up with a new valuation. The first would be, what is the underlying fundamentals of that business? So the EBITDA, the leverage, the margins. The next thing they'll do is they'll look at similar companies in the same industry on the public markets and look at what sort of multiples they're trading at. And then finally, they'll look at similar sort of businesses that have recently been, bought and sold on the private markets, and they'll see what multiples they've traded at. And when they package that all up together, they'll be able to strike a new valuation for the business. We think we really like doing it through a third party because they do it at an arm's length, and it's in our best interest to make the valuations as absolutely accurate as possible. For our global private assets fund, which I know some of your clients are invested in, that fund was up about 9.7% last year, and naturally, given how much the public markets were down, there's questions around how that valuation worked. And so maybe I'll just share with you some stats across the direct equity part, the private equity portion of the portfolio, to give you a bit of a sense of what really drove that performance. On average, EBITDA across our portfolio was up 14%, a double-digit increase. Margins actually increased, which indicated that even with the rising cost of capital, these businesses actually had a pretty good, strong ability to pass on some of those rising costs to their end customers. And finally, debt was paid down on average by around 6%. And so when you combine that all together, even when you take the multiples back on these businesses, it's pretty hard to justify that you should be marking them down.
I think that raises a really good point, because what we see in listed markets is like a reporting season or a result come out, and a company might miss by a small fraction on their top line revenue growth or EBITDA margin, whatever it may be, and the market would severely punish the stock for that in a listed sense. That's something that just doesn't happen as much, well, doesn't happen at all in the private market landscape.
That's exactly right. We're talking earlier about some of the nuances between public and private. I think another really major nuance, which really needs to be appreciated by all investors, is the illiquidity of the private markets. This is not an asset class that you can time or trade in and out of. You really do have to go into these investments with a very long-term time horizon, and traditionally speaking, it's only really been institutions who have really accessed the private markets, given the complex nature of the asset class. But they're locked into these funds that they invest in for 10 years at a time, and so it's very hard to trade in and out of that. And as a result, they're just not driven by sentiment. And the challenge, it's the benefits of that is they don't capture as much of the downside when things are bad, but the flip side of that is they won't capture as much of the upside when the public markets are booming.
Sure. Look, that's a little bit about, I suppose, the volatility and how the fund might perform. Let's talk about, I suppose, the return profile of private equity. In comparison to, say, listed equities, excuse me. I suppose, can you describe the behaviour in different markets, and like your thoughts on that?
Yeah, no, absolutely. It's well known now that private equity outperforms public markets, and it's done that in a number of different conditions in what's been going on in the broader markets. Both during economic booms and then also economic recessions, it outperforms. To the point of what I was saying earlier, I'll stress that again, that it is very hard to time the private markets, and we don't encourage that amongst our clients, just given the challenges of trying to do it. But if you were to look at the data over the last sort of 25 years and broke down just exactly how much outperformance you can expect of the private equity index relative to the public equity index, when the public markets are doing sort of 15% plus, shooting the lights out, it's actually the worst time to have exposure to this asset class, because you're only going to be getting about an outperformance of around 100 bips, which, if I'm being honest, is probably not really worth the hassle of the sort of administrative burden that you take on when investing in this asset class. But when the public markets are in that sort of 5 to 10% range or less, that's actually when it's most important to have this exposure in your clients' books, because the average outperformance you can expect then is about 800 bips, which is significant. Sure. It can really lead to a significant alpha for your clients.
Sure. I think we sort of touched on it briefly before, but one of the main, I suppose, limitations in accessing private equity and private markets in the past for retail clients was the minimums of what you need, and also liquidity. As you said before, a lot of these deals in the past has been fraught with like lockups for 10 plus years. Can you just, I suppose, take us through how you guys are breaking down those barriers?
No, it's absolutely. It's you bang on, and the reason why I said earlier that this has historically always been an institutional asset class is for exactly this reason. If I was to just boil down the essence of what the private market or private equity fund offering is, it's this. It's you're going to promise me a minimum of $10 million. You're not going to know what I'm going to invest that money in. You're not going to know when I'm going to invest it, and you don't know when you're going to get it back. That's the whole premise of a private equity fund, which is a pretty tough pill to swallow, because you're basing that entire decision off the past performance and track record and reputation of the private equity firm that's bringing you the investment opportunity. Pretty funny concept when you consider every fund presentation you ever read says past performance doesn't indicate future performance, but that's just how it works in the private markets. And so The challenges with that is I mean, already a $10 million minimum, even a $5 million minimum investment would rule out just about most private wealth clients in the world. Sure. That's completely unrealistic. Managing those cash flows in the way in and then on the way out of these funds, it's quite complex and burdensome. The pension funds around the world would employ teams of 10, 20 people just looking after all of that for them. And then the other challenge is when you go into one of these fund structures where you've just committed $10 million, they'll probably go out and invest in, I don't know, maybe 10, 15 underlying privately owned businesses. It's not very diversified, particularly if they're a private equity firm that just has one particular niche where they focus on, I don't know, I mean, pick your industry and geography, but you'd be wanting to do sort of 5, 6, 7 of these funds every year. So you can imagine how sort of complex and expensive it suddenly becomes. And then the other challenge is that it's illiquid. You can't get in and out as you please. And so with our Global Private Assets Fund, we've really tried to overcome some of those traditional challenges to really open it up for private wealth clients. That's specifically who we've built this fund for. So you can get into this fund with a $25,000 minimum investment. If you come through platform, it's actually much less than that. On top of that, you don't have to wait sort of 5 to 10 years for you to start getting money back. You can actually come in and out of this fund on a monthly basis. I will stress that that is subject to limited liquidity. So it's what we aim to deliver is 5% of the total fund size per quarter. Total fund size today is about 5 billion. So we'd have to see about 5% of that come out in any given quarter for us to start coming up to the upper limit of what we can return to investors. And then finally, we've really tried to build this as a one-stop shop for our clients' core private equity holding. And the way that we've achieved that is just through diversification. It's incredibly diversified now. It's about 2,000 underlying privately owned businesses spread right throughout different sectors, geographies, the actual general partners, the private equity firms coming in to manage these companies, and then also different stages of the company life cycle. So VC, growth equity, right up to those mega buyouts types of businesses.
I suppose in closing, what's the outlook look like, and why should investors consider an allocation to private equity in their portfolios?
Well, I think that there's a few reasons why almost every institutional fund in the world, and endowment fund and sovereign wealth fund, has increased their exposure consistently over the last 20 years to this asset class. And I think that the two main ones that I'd probably highlight there would be, the first is the outperformance story. I mean, if you looked at the last 22 years worth of data and compared private equity index to the public equity index, private markets or private equity has outperformed every single one of the last 22 years. There's a few drivers behind that, but I think that's too important to ignore and not to consider then for your portfolio. The second thing, though, which I think is a little less known in the market, but very important, is just the diversification benefits. If you were to break down businesses around the world that earn more than 100 mil in revenue, so very big, well-established companies, not sort of corner stores down the road. If you were to break them down between public and private, about 10% of them are listed on a stock exchange. So when you invest in some sort of index, you think you're getting exposure to the economy at large, when in actual fact, you're only getting exposure to about 10% of it, and the other 90% of opportunities that are out there, you're not accessing unless you're going through the private markets. And, unfortunately for the public markets, we think the public markets are by far the most efficient way to allocate resources in an economy. But it's getting harder to find that level of diversification. If you looked at the number of stocks over in the US over the last 20 years, they've almost halved. And what we've seen there is this trend of businesses choosing to stay private for longer. And that's a real challenge, particularly when it comes to trying to access some of those faster growing tech orientated businesses. If they can raise everything that they need to raise on the private markets and avoid that sort of regulatory minefield of going through the IPO process, which is expensive, you've got to disclose everything to the market. You now have to answer to all these different shareholders, each with different views. If you can avoid that and stay private, most founders and CEOs are going to choose that option. And so, in our view, the private markets are just becoming too big of a part of our economy to just not be considering in portfolio construction.
Great answer. Phil, thanks very much for your time. And if you'd like to know more, please get in touch with your GP Wealth Advisor about opportunities in private equity.